Hello, everyone. Welcome to the Edgemoor Investment Advisors fourth quarter 2019 market recap and 2020 outlook. I'm Jordan Smythe, and I'm here again today with my colleague, Gay Truscott. We appreciate your joining us for the next 20 minutes or so. We're trying something a little different this quarter by recording this video presentation and giving it to you to watch whenever convenient. We hope you like this format, and of course, we welcome your comments and your suggestions. I'm going to start us off by reviewing and celebrating 2019, which was a fantastic year in the stock market. I'll also share our outlook for 2020, the first year of this new decade, including both opportunities and risks that we currently see. Gay will then share with you a few of the stocks we're currently buying and some of the reasons we like them. The stock market finished 2019 with a surge in the fourth quarter to new record highs. The almost 32% return of the S&P 500 index was the best annual performance since 2013. And the market has added to those gains as we start 2020. This first slide lists what we see as the key factors behind the market's rise last year, and I'm going to review each in more detail. This chart helps to put in perspective just how good 2019 was and also how good the past decade has been. The average return for the past 20 years for the S&P 500 index has been 6.1%, as you can see from this horizontal red line on the chart. But the past decade has been much better than average, with an annual return of 14.1%, more than twice the 20-year average. Since bottoming in 2009, the S&P 500 index has nearly quintupled. And as you can see from the chart, we've had positive returns every year since then, other than in 2018. You can also see that the previous decade was not a good one for stocks. It started with the dot-com crash with these three down years, 2000 to 2002, and at the end we had the down year in 2008, sharply down in the financial crisis. There are a couple of lessons here. First, markets go up and they also go down, sometimes sharply in either direction. Now that might seem like an obvious comment, but it's one that's often easy to forget after a particularly good year like the one we just had, or after a particularly bad year like we had in 2008. The second lesson is that patience and discipline pay off in investing. For example, waiting for stocks to recover after the financial crisis resulted in huge gains. Foreign stocks also performed well last year. As you can see on this chart, that middle line, foreign stocks were up almost 22%. Those returns were still below the S&P 500 index, though, continuing a recent trend. Bonds also did well, as you can see from the bottom line on this chart, up almost 9% last year, total return, though the returns were still far below those for stocks, as has been the case over the long term. The technology sector led the pack, ending the year up nearly 50%, followed by communication services. As you can see, though, all sectors but energy returned 19% or more, and even the energy sector's 8% return was better than the average market return over the past 20 years. So the gains last year were very widespread across all the sectors. There were several primary reasons for the surge in stock prices. U.S. economic growth slowed a bit, but hovered around 2% for the past three quarters, continuing its steady path. Unlike a year prior, thinking back to December of 2018, few people were talking about the potential for a recession in the near term at the end of this past year. After increasing interest rates for the past several years, the U.S. Federal Reserve began to cut rates in July. It cut 3 times by year end and signaled that it would likely hold rates steady for perhaps all of 2020. Other central banks around the world also lowered rates and took other actions to stimulate economic growth. Despite historically low unemployment, inflation remained close to the Fed's target rate of 2%, as you can see here on this chart. The Fed is watching inflation closely and may change course if inflation rises, but we have enjoyed a prolonged period now of relatively tame inflation. Consumer spending, which accounts for about 70% of GDP and is therefore very important to economic growth, was strong as it has been for several years now. This consumer spending offset a decline in business investment, which we believe is primarily a reflection of the uncertainty caused by the trade wars, and it's also due to the slowdown in the manufacturing sector in particular. Finally, corporate earnings were weak for most of the year, but improved a bit in the fourth quarter. We expect earnings for S&P 500 index to be close to flat for the full year 2019, as shown here in this column, and believe that growth will resume in 2020, though probably not at the 10% rate currently forecast by analysts. All in all, 2019 was a great year, and many of the same positive trends are carrying over into 2020. Before turning to our outlook, I'll share with you some thoughts on current market valuations. Here's a chart showing 25 years of the price-earnings ratio for the S&P 500 index. Price earnings is the most commonly used measure of valuation and indicates the amount that investors are willing to pay for each dollar of earnings from a company, or in this case, from the 500 companies that make up the S&P 500 index. The average price-earnings ratio, or PE as it's often referred to, for the past 25 years has been about 16.3 times, as you can see in this middle dotted line through the chart. The peak occurred at the height of the dot-com bubble, which preceded the 3 years of market declines that I noted on the earlier chart. The low point in the PE ratio during this time period occurred in the depths of the financial crisis and preceded the past decade of very strong returns. The current price-earnings ratio is just above 18 times. This is what it was at the end of last year. It's higher than the long-term average, but far below the dot-com peak. We believe this valuation is still reasonable given interest rates that are near all-time lows and a generally favorable economic environment. Low interest rates lead to the availability of inexpensive capital for investments by companies or individuals. Low rates also make bonds less attractive relative to stocks, leading more investors to purchase stocks and therefore support higher stock prices. The price-earnings ratio is a very important factor affecting future market returns. We think the current level, combined with low interest rates, provides the potential for attractive long-term returns from stocks. I'll conclude my remarks with a summary of our outlook for the coming quarters, starting with the key risks. The first four have been risks for a while. We're optimistic that the recent Phase 1 agreement with China and also the approval of the U.S.-Mexico-Canada trade agreement will improve the trade environment for a bit. As always, the devil is in the details, though, and we will need to see how the details get worked out in this current Phase 1 and subsequent phases of the trade agreement with China. And we've been disappointed here before, but we're going to remain optimistic. We believe improvement on the trade front could lead more companies to commit to investment in equipment and workers, but management teams have been cautious for a while and may not rush back into new investments as quickly as we are thinking they will. Earnings growth could be less than we expect, and political uncertainty surrounding impeachment proceedings and the upcoming presidential election in November also has the potential to keep investors on edge. Finally, coronavirus is a new addition to our list of risks. Some fear a repeat of the disruption in the Chinese and global economies caused by the SARS virus outbreak in 2002 and 2003. We are closely watching the spread of this virus and its impact. Here is our outlook for 2020. We do not expect a recession this year, partly due to the recent progress on trade issues and the avoidance of an all-out trade war. We expect the Fed to sit tight, barring significant changes in the economic outlook, and we believe the U.S. economy will likely continue to expand at a rate of 2% or more, slightly better than in 2019. Ongoing economic growth should allow companies to improve earnings. And better earnings combined with reasonable valuations in a low interest rate environment should enable stocks to hold or even to add modestly to their gains. though volatility has already ticked up and is likely to remain higher than it has been recently. And we expect value stocks, those that trade at lower price-to-earnings ratios and are less expensive based on other fundamental measures, will perform better than growth stocks. Value showed signs of a resurgence last year, and we remain confident that value stocks like those in our portfolios will regain favor with investors, who may turn more defensive and focus more on fundamentals in this 11th year of the bull market. I'll now hand the presentation over to Gay for her discussion of a few of the stocks we're currently buying.
Thank you, Jordan. In our latest newsletter, we highlighted 3 stocks we are currently buying, which I'd like to review for you now. The first, Alphabet, the parent company of Google. Alphabet is a global technology company best known for its dominant search engine, which controls 80% of online searches. The company was founded in 1998, went public in 2004, and just recently surpassed a market capitalization of $1 trillion, only the 4th company to do so. Google's internet assets include Gmail, YouTube, Google Maps, and Google Play, as well as the Chrome internet browser and the Android operating system, which powers 75% of smartphones around the world. Together, these core assets provide a cohesive end-to-end user experience for consumers and, most importantly, drive advertisers to Google sites. Nearly 90% of Google's revenues come from advertising, including from fast-growing mobile advertising, which Google also dominates. Advertisers have increasingly consolidated their spending around companies like Google that offer a broad platform, a vast user base, and unique assets. Alphabet's financial position is as strong as its market presence. In 2019, the company generated a record $160 billion of revenues, $22 billion of cash flow, and had more than $120 billion of cash and marketable securities on its balance sheet, compared to just $4.2 billion of long-term debt. As you can see on the chart, Alphabet stock trades at a premium to the market that you heard Jordan discuss, at 26.5 times forward earnings. But we believe this premium is justified by Google's higher than average earnings growth rate, nearly 17% projected for the next 5 years annually, as well as the company's market dominance, market share, and other competitive advantages. Next on the chart, Bristol Myers Squibb. Bristol Myers is a global biopharmaceutical company that produces a broad range of conventional prescription drugs, as well as advanced specialty pharmaceuticals focused in the areas of oncology, immunology, and cardiovascular disease. As part of a strategic push into specialty pharmaceuticals, Bristol Myers acquired rival drug maker Celgene last year for $74 billion, creating one of the largest global healthcare companies and further repositioning Bristol Myers as a leader in the lucrative specialty pharmaceuticals arena. It also provided the company with one of the most promising pipelines of new drugs in the industry. We have a favorable view of this acquisition and believe it will be good for shareholders over the long term. Not only will it add several new blockbuster drugs to the company's current lineup, but should help drive growth over the long term, with several new Celgene drugs recently approved by the FDA. Together, these new developments could boost revenues by 50% over the next 5 years and contribute to earnings growth of 30% projected by 2022. Bristol Myers is financially strong and shareholder friendly. The company recently increased its dividend by nearly 10% and announced a new $7 billion share buyback program in late 2019. As you can see on the chart, the stock trades below the market average PE ratio at just 11 times forward earnings and offers an attractive dividend yield of 2.7%. And finally, Simon Property Group. Simon Property is a real estate investment trust, or REIT, that owns, develops, manages, and leases high-quality regional malls and premium outlets throughout the U.S. and abroad. Simon is one of the largest owners of retail properties in the world and is also the largest publicly traded retail REIT with a market capitalization of nearly $45 billion. Some might ask, why would you want to own a mall owner in this era of Amazon and the supposed demise of bricks and mortar retail? Well, let us tell you why. Simon's size, its scale, its geographic diversity, and its high-quality properties puts it squarely in the category of mall owners that are not only surviving, but thriving. Simon Properties continue to be attractive to major retailers who generate average sales of $680 per square foot at Simon Properties, clearly putting them in the Class A mall category. In addition, Simon Properties have consistently enjoyed average occupancy rates of over 95%. But rather than resting on its laurels, Simon has been actively redeveloping many of its properties to add experiential tenants like entertainment venues and fitness centers, as well as adding mixed-use tenants like hotels, office buildings, and residential space to drive foot traffic and usage. To date, Simon has spent nearly $5 billion on redevelopment projects and plans to spend another $5 billion in the next few years. Simon enjoys a strong single-A credit rating that has allowed it to finance these projects at very attractive rates. The company has also grown its dividend 11% annually for the past 5 years, and its shares currently yield an attractive 5.7%. Again, as shown on the chart, the stock trades at just 11.7 times funds from operations, which is the typical valuation for REITs, which is well below the stock's 5-year average. So in conclusion, despite the prevailing fear of a retail apocalypse, we have found many reasons to like Simon Property Group, and we're pleased to add this high-quality, high-dividend-paying holding to our income buy list last year. And with that, I will turn it back over to Jordan.
Thank you, Gay, and thanks to everyone for attending today. We hope you enjoyed this presentation and the video format, and we welcome any comments or suggestions you might have for future presentations. We'll be back again in 3 months with our next quarterly commentary.